there's two absolute rules of option contracts. Number one, they will fluctuate in price. And the reason that we've put on a spread like this is because we've given it a lot of room for the price to move around in. It will fluctuate in price. So we've given it lots of room. The second absolute rule of option contracts is they expire. So what happens is today, yes, our option contract looks like this, our profit and loss looks like this, and we've lost $2.93. But over time, look what happens. This is today, the white line. This green line now has turned, is about a week from now. Now, a week from now, all of a sudden, if our price remains relatively stable, all of a sudden we have a profit of, where is it? $4.15. Then, if we go all the way out to May 4th, which is just a couple weeks away, our profit is now $14.75. The options, remember, the options will expire. So, the further out, let's say if you buy a 90-day option, an option that expires in 90 days is going to be worth more money than an option that only has 30 days left to it, right? Because the closer you get to expiration, the less probability that option will actually have any value if the price remains relatively stable. If the prices, of course, prices do fluctuate all the time, so that price option contract is actually going to be worth more money at one point and less money at some point. Then, as we get very close to expiration, like 30 days prior to the expiration, well, all of a sudden at that point, then prices become, the option contract loses value on a daily basis. And let me just show you what it looks like on a real trade that we did. I can show you exactly what this looks like on a real trade. This is our green line, which is on a portfolio weighted basis, our entire position. And this white line, I mean, when we first put on the trade, it was way down here. You can see that we have the strike prices of the stock down here, and in this case it's the EEM, which is the emerging market ETF, and this is our profit and loss. We had a maximum profit of close to about $1,000 on this trade. We are just a few days from expiration, and our live price was $139.47, and this white line is our current profit position. When we got started, it was down here, but each day that we continued to hold this trade, it kept going higher and higher and higher and higher and higher and higher. And now at this point, we are about 1 week from expiration. If you take a look at the current live price down here where I've highlighted it, the important thing to think about is theta. We're going to go through each one of the Greeks in the next CD because they're extremely important. This is where you make your money. The theta was $48.25, and all that really means is that for each day that passes, we have the option contract is declining by $48.25 each and every single day. If we take a look at our current profit and loss open, we have a $500 profit so far on this trade in just 2 weeks on this one trade, and we are generating $148.33 in profit per day, every single day. So as long as we continue to hold this trade, this white line will continue to go up and up and up until we meet our maximum profit. Generally, though, we do not like to hold our contracts all the way to the expiration. We usually will try to close them out right around at the 50% to 70% mark, and sometimes down at the 30% mark, depending on what kind of price risk we think we have. But this is holding relatively stable. Now we had to adjust this trade. In other words, our current price is 139.47, which is right in the center of this, what we like to call our profit graph, our profit picture. We love profit pictures. Profit pictures are extremely important, not only for determining when adjustments are necessary, but it's also extremely important to see exactly where our profit and loss figures are, because once, remember I showed you that if the price gets up to our break-even points, we need to do an adjustment. And we had to do an adjustment on this trade because the price had gotten very far up the line here, and we needed to adjust our trade so that it comes back towards the center. Being in the center of this profit graph will ensure that you are always in a profitable position in a trade. It doesn't mean that you're always going to have a profitable trade. It only means that if you do adjustments at the right time, and the time of your adjustment is very, very important, then you will never get hurt really, really bad in the market, and you put yourself into a position where you can be profitable. So this is typically what the winding down of a very, very good trade will look like. You will be making money every single day. You will have a very positive profit position, and as you can see from this, the current price is 139.47. We're making $148 a day, but even if the price were to move against us by 2 points, we're still making $100 a day, and if it goes down by 2 points, we're making $130 a day. So either way, this was a very profitable position that we closed out, and that's what it looks like. That's what a profitable position will look like. And that's exactly what this graph will show you, is that over time your position will become more profitable and more profitable and more profitable, because that option, when it gets closer to expiration, will lose value. You've sold that option to someone else who thinks that the market was going to go in a certain direction. It didn't, and you were able to collect that time premium for that contract.